A slowing recovery and markets that continue to fall. Not the best news for investors. But let's get some perspective from my next guest. He's an expert when it comes to value investing. Scott Black, president of Delphi Management. He's got about $1 billion worth of assets that he's responsible for. Scott Black, good to have you with us on Bloomberg. We were just talking before you came on that this is like a casino market. It makes small work of people that are interested in value. Explain.
The problem is people look at the comparison against the best estimate. So if a company, even if they hit the revenue number and they're short on the earnings, the stock goes down, even if it's an 8 PE, and vice versa. You can have a very high multiple stock, and they beat the estimate by 3 cents, and a 20 multiple stock goes to 22 times earnings with no rhyme or reason. So there's too much short-term trading, and it's also a news-driven market based on the last piece of data, which is unfortunate because actually, Pimm, the market as a whole, where the S&P is roughly a 14 PE, and S&P earnings should be very good this year, about $95, up about 15%, and we're getting some top-line growth as well, roughly 13%. So the corporate sector actually is doing pretty well, but it's not reflected in the multiples in the stock market.
Well, Scott, it certainly is reflected in the credit markets. I mean, you saw Johnson & Johnson coming out today issuing a lot of debt, taking advantage of low interest rates. How is it that companies know something that investors are ignoring?
Well, I think it's a short-term trading mindset. I think I'm an anachronism. There aren't too many people that buy and actually own stocks, with a 3 to 5 year time horizon anymore. I'm a big believer, as Benjamin Graham and Buffett always say, value will out. But there's really a tumultuous market, and it's based on whether the commodity prices sink on a given week or whether we have problem with the debt restructuring in Europe. And people aren't looking past the earnings, which are really outstanding. And also corporate balance sheets in the United States are holding close to $1.9 trillion in liquidity, which is an all-time high, Pimm.
Have you seen this kind of situation before in your investing career, Scott?
Sure we have. We had the tech bubble in the late 1990s through the topping of the NASDAQ around 2001. But I think it's much more hair trigger oriented than it has been in the past. People don't have any real conviction. I mean, if you get a good company selling at 7 or 8, 9 times earnings and earns 20% on book and generates cash, it's worth holding for more than 2 picoseconds.
All right, well, let's talk about one of those companies selling for about 8 and 9 times. Let's talk about Advanced Energy Industries. This is a company that really is working to secure its market share when it comes to taking energy that is produced from, let's say, solar panels and converting it into usable energy. Tell me about this maker of inverters.
Well, really, the company is a power source for wafer etch and PVD, CVD. Historically, they supplied Lam Research, Novellus, and Applied Materials, and that's still 72% of the revenue. The business that you alluded to earlier is only 28%, but that's growing by leaps and bounds. So that even if next year the semiconductor capital equipment stagnates, it should still be a 10–15% grower. The stock will do about $1.70 in earnings this year. It's an 8 multiple, but there's $3.22 in cash on the balance sheet. If you back that out, it's a 6.5 PE, and we're looking for about $1.85. The other thing is this power inverter business that you alluded to, the margins are very low now. They're single digit, whereas the whole company is over 17%. We just met with the management. There are economies of scale as they roll out the business. The inverter business for solar will also come to a double digit, so you get operating leverage as well.
Now, Scott, they've also got some special sauce, right? Because they just announced that they've got a 98% efficiency conversion, which has got to help their solar business. And I know they've got a big project just outside of Phoenix.
You're right. They have a high efficiency, but there is competition. There's Siemens in the space, and there's a company called Power One, which is mostly residential, but is going to creep over into the industrial space and utility space as well. But at this point, AEIS has the wind to their back. The key is whether the United States government's part of its energy policy continues to push for solar through the next decade, and that would be highly beneficial to them.
Now, this project outside of Phoenix, this is going to end up being a 500-megawatt project. It is a Sempra Group project. Is Advanced Energy going to get more contracts like this?
They will, and they're competing for it. I mean, they wouldn't give you the RFPs that are out there, but they point out, you know, how many megawatt potential there is, and it does bode well for the company, Pimm.
All right, Scott Black, talk about business development companies. First, explain for those that are not familiar, what are they and how can they pay such substantial dividends?
Well, it's almost similar to a REIT in that they have to distribute 90% of their cash flow, but they can't get in trouble in that they can only leverage maximally 1-to-1 the debt against the equity. And the one we have, Ares Capital, the net debt equity is really only 0.37 at this point. So they have roughly $800 to $1 billion worth of capacity to expand the portfolio without having coming back to the equity of the debt markets directly. So it's a cheap stock. For those people out in the audience that want a yield, you get about an 8.4% yield. The stock is selling at 1.08 times tangible book. And although this is structured financing, and that was a dirty word in 2008, they'll reserve for losses, or I should say the delinquencies are only about 2.8%, which is very low relative to the $4.2 billion portfolio. And they have a well-diversified portfolio. It's in healthcare, industrials, food service, and so no one credit really accounts for more than, for even 5%. And the average coupon is roughly 12.6%. The average funding cost is 550 basis points, so you have a net interest margin, 710 basis points. And senior secured and junior secured debt is over 70% of the portfolio. They're not moving down the capital structure to get the yield, which is very important.
Scott, you've described how you were in the stock, then you got out of the stock, now you're back into the stock. Tell me about the acquisition that Ares made of Allied Capital and why that caused you some concern, but now you're at least you're feeling pretty good about that.
Right. Mike Arrighetti came to visit us. At the time of the acquisition, we didn't think it was congruent with their own business because initially they did their own originations. They had their own credit people internally that kicked the tires. And to buy a big pool as they did wasn't really the same as what made them famous along the way. But they've worked out the portfolio. They retained a few of the key people there, and they've gotten the credits into shape. And out of the roughly 2% plus, only 1.5% of the loans are delinquent at Allied. So I think that they've done a good job digesting Allied, and I think now it's on the right track again.
Scott, you mentioned this idea of delinquency, and I previously spoke with Marty Fritzen of BNP Paribas Capital Asset Management, and he was saying that the delinquency rate, particularly when you look at things like high-yield debt, that's actually going down right now. Is it because the economy is healthy or because the covenants, the loan agreements, are pretty loose?
No, I think it's because the economy is doing well. They have a well-balanced portfolio, and their portfolio companies are performing pretty well. I think that's the real issue.
What about the access to additional capital? Do you think they're going to be able to get it at these low rates?
Well, they have. They have a LIBOR pricer. I said the all-in cost is roughly 5.5%, but at the margin, they have a bank credit with LIBOR plus a spread that's below 5.5%. They accessed the markets earlier in the year with a convertible with a very low coupon. And so I think that they continue to raise capital, and as long as you can borrow at 3-4% and spread it at 12.5%, as long as you don't make credit mistakes, it's a pretty good business.
Well, having said that about the U.S. economy and how it at least is improving, and that should show up in Ares Capital, why so many naysayers about the future of the U.S. economy?
I think the real issue is the overhanging deficit. If you look at the total deficit now as a function of nominal GDP, it's 96%. It's the highest ratio since the end of World War II. And it seems to me that both sides, the Democrats and the Republicans, are posturing. And really, we need some political action, not posturing. And I think that's the big concern as you look up past the horizon 6 to 9 months.
So if we get any kind of agreement on the debt ceiling, do you think that's going to make investors a little bit more, well, happy to be investing in shares, in stocks?
not the debt ceiling per se, with the proviso that they actually do something about the entitlements. You cannot put this budget back into order unless you touch Medicare, Medicaid, and Social Security. And the fact is the United States is going broke. I saw an OMB number that forecast that if the path we're on by 2020, the interest on the debt would be over $820 billion a year alone, almost double from where we are today. And that's just an untenable situation.
Oh, Scott, come on. You can come up with that cash for us. Do you think they're going to reach some kind of agreement?
I hope so, and I hope they have some political will before the presidential election, because, as I said in Barron's earlier in the year, they've been kicking the can down the road, but it's time to really stop the nonsense. You know, I'd like to think that the representatives we send to Washington of both political stripes would act on the benefit of the American people, but it hasn't been this way for a while, and it's really disappointing.
All right. Never a disappointment to have you with us. Thank you very much, Scott Black, Delphi Asset Management, joining us from Boston.